What if the person managing your retirement savings isn't telling you the whole truth? You trust them with your future. You assume they're looking out for you. But behind the suits, licenses, and polished language, some retirement advisors are hiding things, subtle choices, quiet omissions, and dangerous assumptions that could quietly sabotage your financial security. And most people never see it coming until the damage is already done. They don't lie outright. They don't need to. All it takes is skipping a few details here, glossing over a few numbers there, and suddenly your carefully planned future is resting on a foundation that's far weaker than you thought. And the worst part, the red flags were there all along. In this video, we're going to walk through 4 warning signs that your advisor may be hiding something dangerous, whether it's intentional or just part of a broken system. These aren't wild conspiracies or dramatic gotchas. They're quiet clues most people miss until it's too late to fix them. If you're retired or planning to be, this isn't just about protecting your money. It's about protecting your freedom, your options, and your peace of mind in the years ahead. Because once things go wrong in retirement, there's no easy way to start over. Let's look at what your advisor might not want you to know. The first red flag is often the most overlooked. Your advisor avoids talking about fees in detail. They might say the plan is low cost or that the fees are built into the portfolio, but when you ask for a full breakdown, the answers get vague. That's not a mistake, it's a strategy. Because once you start digging, you'll realize how many layers of fees are quietly draining your money over time. Management fees, advisory fees, fund expense ratios, hidden commissions. Each one might seem small, but they add up fast. And the longer your money stays invested, the more those fees compound against you. Over the span of 20 years, even a 1% fee difference can mean hundreds of thousands of dollars lost. Some advisors work on commissions, others charge a flat percentage of assets, and some do both. But unless they're upfront about exactly how they're getting paid and how much, it's hard to know whether their advice is serving you or serving their bottom line. The worst part? Many investors assume their advisor is fee transparent just because they handed over a disclosure form. But those forms are often buried in legal language and never fully explained. If your advisor isn't eager to walk you through every charge, line by line, that's a red flag. Because if someone hesitates to tell you how they're making money from your account, what else might they be keeping from you? And as you'll see next, it's not just what they don't say. It's how they present the future that can quietly mislead you. The second red flag? Your advisor promises predictable returns. They might not say it outright, but listen closely. If they're building your entire plan around a fixed annual growth rate, like 6%, 7%, or even 8%, without factoring in real-world volatility, that's not planning. That's storytelling. Because no one, not even the smartest advisor in the world, can guarantee how markets will behave over the next 10, 20, or 30 years. Markets don't move in smooth lines. They surge, crash, stagnate, and surprise. Inflation spikes, wars break out, recessions hit when no one expects them. Yet, some advisors still base retirement projections on rosy, linear models where everything goes exactly as planned. No major downturns. No inflation shocks. No sequence of returns risk. It feels comforting to see a chart where your money grows steadily every year. But comfort isn't the same as truth. And if your advisor isn't building in realistic scenarios like a sudden market drop early in retirement or higher than expected living costs, then your entire plan could fall apart the moment real life kicks in. The danger here isn't just being wrong. It's being unprepared. Because when your plan is built on an assumption that everything will go well, there's no room for error. And in retirement, you only get one shot. So, if your advisor is promising smooth, consistent growth without showing you how things could go wrong, they're not giving you confidence. They're giving you a false sense of security. And sometimes that illusion of safety is used to steer you into something even riskier than you realize. The third red flag? They start pushing complex financial products you don't fully understand. It usually begins with something that sounds comforting: guaranteed income, principal protection, no downside risk. Maybe it's an annuity, a structured note, a private REIT, or some kind of hybrid retirement solution. The names change, but the pattern stays the same. Your advisor introduces a product that seems too good to be true and never quite explains how it works. They gloss over the fine print. They focus on the benefits, skip the trade-offs, and brush off your questions with phrases like "it's very standard" or "you don't need to worry about that part." That's not advice. That's a sales pitch. The truth is, many of these complex products come loaded with high fees, limited liquidity, lockup periods, and payout rules that can change over time. And guess what? The advisor often earns a commission upfront just for getting you signed. That doesn't mean every annuity or structured product is a scam. Some can be useful in the right situation. But if your advisor is pushing one solution without showing you alternatives, or if they seem uncomfortable when you ask for specifics, that's a problem. Because no matter how professional they seem, if you don't understand what you're buying, you shouldn't buy it. Period. A real advisor educates you. They help you understand the risks, the rewards, and the fine print. A shady one just tells you to trust them and hopes you won't read the contract too closely. But even more dangerous than what they pitch is what they refuse to talk about at all. The fourth red flag is the one most people miss until it's too late. Your advisor avoids discussing worst-case scenarios. They'll show you charts of growth, projections of steady income, maybe even a colorful graph of how your money could last until age 95. But what they won't show you is what happens if things don't go according to plan. What if there's a major market crash early in retirement? What if inflation hits 7% again? What if you or your spouse need long-term care for years? A solid retirement plan should be stress-tested. It should show you not just the sunny path, but the storms that could hit along the way. It should answer questions like, what happens if I retire into a bear market? What if my expenses double because of a health crisis? What if I live longer than expected and outlive my savings? But many advisors avoid these uncomfortable scenarios, not because they don't matter, because they do, but because they make the plan look fragile. And fragile plans don't sell well. Instead, they downplay the risks. They assume markets will rebound quickly. They assume medical costs will be covered by insurance. They assume you'll adjust your spending if things get tough. But those are just hopes dressed up as strategy. Real planning isn't about pretending everything will be fine. It's about preparing for when it won't be. Because when the unexpected happens, and it will, you don't want to be scrambling. You want a plan that saw it coming. And if your advisor isn't helping you prepare for those tough conversations now, they might be the very reason your future becomes one of those worst-case scenarios. Your retirement advisor isn't just managing money, they're shaping your future. And if even one of these red flags sounds familiar, it's time to stop assuming everything is fine just because they sound confident or wear a nice suit. Because confidence can be rehearsed, and credentials don't guarantee honesty. The real danger isn't that they're lying to you, it's that they might be keeping things just vague enough for you not to ask questions. Glossing over fees, overselling returns, pitching complex products you don't fully understand, ignoring the realities of what can go wrong. These aren't small oversights. They're cracks in the foundation of your financial life. And once you've retired, those cracks don't just stay small. They grow, slowly, quietly, until one day a market drop, a medical bill, or a missed assumption exposes everything you didn't plan for. So, if your advisor can't explain where every dollar is going, if they avoid hard conversations or push you toward things you don't understand, don't stay quiet. Ask more questions, demand clarity, or get a second opinion from someone who puts transparency first. Because this isn't just about numbers on a page, it's about the freedom you've spent a lifetime working for. And the person guiding you through retirement should be the one protecting that future, not putting it at risk behind a polished smile.